In this video, we are going to examine what causes the entire aggregate demand curve to shift. The simplest method is to begin with the aggregate demand formula. AD equals consumption plus investment plus government spending plus export minus imports. If one of these components changes independently of the domestic price level, the aggregate demand may shift. An increase in aggregate demand shifts the curve to the right, and a decrease in aggregate demand shifts the curve to the left. Now let's start with the first AD shifter, consumption. Consumption is household spending on goods and services. It usually forms the largest component of aggregate demand, so changes in consumption can have a very significant effect on the economy. Consumption can change due to changes in disposable income, which is the income households have available after direct taxes and direct benefits have been taken into account. If income tax falls, households keep more of their income, and this increases disposable income, and it may increase consumption. So the overall logical chain is a lower income tax induces higher disposable income, induces higher household consumption, which will result in an increase in aggregate demand, causing AD to shift rightwards. The strength of this effect, of course, depends on households' marginal propensity to consume, which we are going to cover later. But in short, some households may spend most of their additional income while others may save it or use it to repay debt. Second, consumer confidence. Consumption also depends on expectations. Suppose households become more confident about their future employment and future income, they may become more willing to make expensive purchases or borrow money for consumption. So, higher consumer confidence results in households being more willing to spend, leading to higher consumption, and therefore AD will shift rightwards. But during a recession, the opposite may happen. Even households whose incomes have not yet fallen may reduce their spending because they fear unemployment. So expectations can change current spending before actual income changes. And changes in interest rates also influence consumption. Lower interest rates can increase consumption through several channels. First, borrowing becomes cheaper. Second, households with variable rate mortgages may face lower monthly repayments, and this leaves them with more disposable income. Also, the lower interest rate makes saving less attractive. Therefore, lower interest rates means cheaper borrowing and lower debt repayment. And that leads to higher consumption, causing aggregate demand to shift rightwards. However, savers receive less interest income, so the final effect may vary between different households. Finally, household wealth. If house prices or share prices rise, asset-owning factories may feel wealthier, and they may increase spending even if their current income has not changed. And this is known as a positive wealth effect. However, rising house prices do not benefit everyone equally. Well, now let's look at the second AD shifter, investment. Investment is the spending by firms on capital goods such as machinery, technology, factories, and equipment. It is strongly influenced by expected profitability. Now, business confidence influences the level of investment made. Imagine a restaurant considering opening in a second location, and the decision depends on whether the owner expects sufficient future demand. If the firm becomes more optimistic about future sales, it may increase investment. So higher business confidence means stronger expectation of future demand and profits, and more investment projects are becoming more attractive, and investment is going to rise, and that pushes aggregate demand rightwards. This also shows why investment can be volatile, as expectations can change fairly quickly. Changes in interest rates also influences the level of investment. Many investment projects are financed through borrowing. Lower interest rate reduces the cost of finance. They also reduce the return firms could receive by keeping money in financial assets. So this makes real investment relatively more attractive. So lower interest rates means lower cost of borrowing and more profitable investment projects. Therefore, investment demand increases, pushing aggregate demand to the right. Also, changes in corporation taxes influences investment. A reduction in corporation tax allows firms to retain a greater proportion of their profit, and this may increase the funds available for investment and raise the expected post-tax return for new projects. The effect is not automatic, however. Firms will not invest simply because they have more cash. They must also expect sufficient demand. Finally, capacity utilization influencing the level of investment. Suppose a factory can produce 10,000 units, but is currently producing only 5,000. It has substantial spare capacity. Even if demand rises slightly, the firm may be able to increase production without purchasing new equipment, new machinery. By contrast, if the factory is already very close to full capacity, rising demand is more likely to encourage investment. And a third aggregate demand shifter is changes in the level of government spending, which is an autonomous factor. Government spending includes expenditure on areas such as healthcare, education, defense, transport, and infrastructure. An increase in government spending directly increases aggregate demand, pushing it rightwards. For example, if the government decides to fund a railway project, construction firms are going to receive some new contracts and government spending will rise, pushing aggregate demand rightwards. Well, government spending decisions may depend on the government's fiscal policy objectives, the stage of the business cycle, political priorities, and the condition of public finances. During a recession, a government may deliberately increase spending in order to support the economic activity. However, increased government spending may require a higher taxation or borrowing. Both of these are going to create very severe later consequences. Well, let's look at the fourth aggregate demand shifter, changes in export. Exports are goods and services produced domestically and purchased by foreigners. So changes in foreign economic growth is going to increase our country's export. Suppose incomes rise rapidly in United States. American consumers and firms may purchase more goods and services, including imports from UK. Therefore, higher foreign incomes means higher foreign demand for UK goods. That causes UK exports to rise and AD to shift rightwards. This means one country's economic growth can create a demand for output produced in another country. Fluctuations in exchange rates can also influence export. If the pound depreciates, UK goods become cheaper for foreign buyers, while foreign goods become more expensive for UK consumers. This may increase UK exports, pushing UK aggregate demand to the right. Relative inflation is also a factor that could change export. If UK inflation remains lower than inflation among its trading partners, UK goods may gradually become more price competitive. This can increase UK export and shift aggregate demand to the right. But competitiveness can also depend on non-price factors such as quality, reliability, design, and the quality of customer services. But let's look at one final aggregate demand shifter. Changes in imports. Imports must be handled quite carefully because they are subtracted from aggregate demand. If import increases while everything else remains unchanged, aggregate demand is going to fall. Changes in domestic income is going to influence the level of imports. When domestic income rises, households often purchase more goods and services. Some of these additional spending will be on imports. So higher domestic income means higher demand and higher demand for foreign goods. Imports are going to increase, net export will fall, and aggregate demand is going to shift left because import increased. Well, changes in exchange rate is also going to influence imports. An appreciation of domestic currency makes imported goods cheaper. Consumers and firms may therefore purchase more imports. At the same time, exports may become more expensive for foreign buyers, and both of these effects can reduce net export and push aggregate demand leftwards.